Decentralized exchanges DEXs, an in-depth overview. Introduction. Decentralized exchanges DEXs are platforms that facilitate peer-to-peer trading of cryptocurrencies directly on the blockchain without the need for a central authority or intermediary. Unlike centralized exchanges CEXs, which rely on a central entity to manage trades and hold users' funds, DEXs operate on decentralized protocols, providing greater security, privacy, and control over assets. Key features of DEXs: decentralization. DEXs operate on blockchain technology using smart contracts to execute trades. No single entity controls the exchange. It is governed by code and, in some cases, community governance. Non-custodial. Users retain control of their private keys and funds at all times. Reduces the risk of hacking or loss associated with centralized exchanges holding users' funds. Privacy. DEXs typically do not require extensive personal information or KYC know your customer procedures. Users can trade with a high degree of anonymity. Security. Enhanced security as funds are not stored in a centralized repository, reducing the risk of large-scale hacks. Transactions are executed directly from users' wallets, minimizing third-party risks. Global access. Accessible to anyone with an internet connection and a cryptocurrency wallet, promoting financial inclusivity. No geographic restrictions, as they are not tied to specific regulations of a single country. Transparency. All transactions are recorded on the blockchain, providing complete transparency and auditability. Users can verify transactions independently, enhancing trust. Types of DEXs. Order book DEXs maintain a record of all buy and sell orders in an order book. Example: 0x. Protocol: Loopring. Automated market makers AMS use liquidity pools instead of order books. Liquidity providers deposit funds into pools, and an algorithm sets the price based on supply and demand. Examples: Uniswap, SushiSwap, Balancer. Hybrid DEXs combine features of centralized and decentralized exchanges to offer a middle ground. Example: Diversify. How DEXs work? Smart contracts. Smart contracts automate the trading process, executing trades according to predefined rules without the need for intermediaries. Liquidity pools. Users' liquidity providers deposit pairs of tokens into smart contracts, creating pools that facilitate trading. In return, liquidity providers earn a portion of the trading fees. Swapping. Traders can swap one cryptocurrency for another directly from their wallet using the DEX interface. The DEX's algorithm determines the exchange rate based on the liquidity pool balances. Decentralized governance. Some DEXs are governed by decentralized autonomous organizations DAOs, where token holders vote on key decisions and protocol changes. Popular DEX platforms. Uniswap pioneered the model, allowing users to trade tokens directly from their wallets, utilizes liquidity pools and an easy-to-use interface. SushiSwap, a fork of Uniswap with added features like yield farming and governance, offers incentives for liquidity providers in the form of sushi tokens. PancakeSwap, built on Binance Smart Chain BSC, known for lower fees and faster transactions compared to Ethereum-based DEXs, features liquidity pools, farming, and staking opportunities. Curve Finance specializes in stablecoin trading, offering low slippage and high efficiency. Uses a unique algorithm optimized for assets with similar values. Balancer allows users to create and manage custom liquidity pools with multiple tokens and different weightings. Provides a flexible and programmable environment for liquidity provision. Benefits of DEXs: control over funds. Users maintain control of their private keys and assets, reducing the risk of theft or loss associated with centralized exchanges. Lower fees, typically lower fees compared to CEXs, especially when trading on networks with low transaction costs. Censorship resistance. Decentralized nature makes it difficult for authorities to censor or shut down the exchange. Inclusive access, open to anyone globally without the need for extensive documentation or verification. Challenges and risks. User experience. Interfaces can be less intuitive compared to CEXs, posing a challenge for beginners. Requires knowledge of wallets and private key management. Liquidity. Some DEXs may suffer from lower liquidity, leading to higher slippage and less favorable trading conditions. Smart contract risks. Vulnerabilities in smart contracts can be exploited, leading to potential loss of funds. Regulatory uncertainty. Regulatory frameworks for DEXs are still evolving, and future regulations could impact their operation. Impermanent loss. Liquidity providers risk impermanent loss if the price of the tokens in the pool changes significantly. Future of DEXs, layer-to solutions, integration with layer-to scaling solutions, for example, optimistic rollups, ZK rollups to reduce transaction costs and improve speed. Cross-chain functionality. Development of cross-chain DEXs to enable seamless trading across different blockchain networks. Improved usability. Enhancements in user interfaces and experience to make DEXs more accessible to mainstream users. Regulatory compliance. Balancing decentralization with compliance to adhere to evolving regulations while maintaining core principles. Advanced financial products. Introduction of more sophisticated financial instruments like options, futures, and derivatives on DEXs. Conclusion. Decentralized exchanges are a cornerstone of the DeFi ecosystem, offering a secure, private, and accessible alternative to traditional centralized exchanges. While they come with their own set of challenges and risks, ongoing innovation and development are addressing these issues, paving the way for broader adoption and integration into the global financial system. As technology and regulations evolve, DEXs are likely to play an increasingly vital role in the future of finance.